Okay, this might surprise you. In just the last 3 years, over $100 billion has flowed into covered call ETFs. People are hunting for income that actually keeps up with rising costs, and these funds have become the go-to place for it. Because with covered call ETFs, you can realistically earn around 8% to 15% plus a year in income without constantly trading or touching your original capital. On this channel, we break down retirement investing and income management, so if you're into that, feel free to subscribe. Today, we're going through 7 of the best covered call ETFs, the biggest mistakes people make with them, and the exact framework to build a sustainable, long-term income portfolio. All right, before we jump into the best covered call ETFs, I need you to understand something important. All the picks later in the video are based on 3 metrics that most investors never even look at. And honestly, these are the exact things that separate a strong income portfolio from one that slowly drains your money. Metric number 1 is total return, not just the yield. And this is where so many people get misled. When you see an ETF showing a 15%, 20%, even 30% distribution rate, that is not the actual return. The real number that matters is your total return, how much your account grew after all the income and all the price movements. Because here's the truth, there have been many instances with ETFs having massive yields and still losing money if the ETF's price keeps falling. A high yield means nothing if the NAV is dropping faster. That's why people think they're making money, but their portfolio is shrinking. Metric number 2 is NAV stability, or even better, NAV growth. Covered call ETFs naturally pay out a lot of cash, and when they distribute more than they actually earn, the NAV slowly drifts down. The payout itself isn't a loss, it's just the fund handing value back to you. But if the underlying value keeps getting smaller year after year, that's a real problem. And here's something most people don't realize. Only about 40% of covered call ETFs have actually grown their NAV since launch. The rest are slowly eroding. This single metric removes more than half the ETFs people talk about online. Metric number 3 is tax efficiency. And this is a big one, because 2 investors can earn the exact same income, but one ends up paying thousands more in taxes. Some covered call ETFs are taxed at ordinary income rates, which is the highest. Others generate short-term capital gains, also high. But some use option structures that get taxed more favorably, and a few even return part of the payout as return of capital, which basically defers the tax bill. To put it simply, the same $50,000 of income can lead to completely different tax bills, depending on the ETF. Sometimes an $11,000 bill, sometimes $18,000+. And depending on the structure, some funds work best in a taxable account, while others absolutely belong in a Roth or IRA. Now that you understand how I'm evaluating these ETFs, total return, NAV stability, and tax efficiency, we can start breaking down each ETF. And trust me, this is where the real differences start to show. And if you're enjoying the video, make sure to tap the like button. It helps the channel so much. All right, let's start with the foundation, the S&P 500 covered call ETFs. These are the core income funds. They're built on the S&P 500, so they're naturally more stable than the high-yield, high-risk stuff we'll talk about later. And if you've never used covered call ETFs before, this category is usually where you build your base. My top pick here is GPIX from Goldman Sachs, and the reason it's number 1 is simple. It's one of the few funds that actually gives you solid income and strong total returns at the same time. Right now, it's yielding around 8%, but the crazy part is that in 2024, it returned almost 22% total. That's not normal for covered call funds. Most of them sacrifice growth to get income, but GPIX manages both because it uses something called dynamic overwrite, which just means it doesn't write the same amount of options all the time. Sometimes they cover 25% of the portfolio, sometimes 75%, depending on the market. So it adapts instead of locking itself into one rigid strategy. And the expense ratio is incredibly low at 0.29%, which is one of the best in this entire category. Now, if you want a runner-up, and especially if you're investing in a taxable account, SPYI is the one you should look at. This thing is a tax efficiency machine. It uses Section 1256 contracts, which get taxed in a more favorable 60-40 split. And on top of that, a part of the payout comes as return of capital, which basically pushes some taxes into the future. And even with all that income, the NAV has actually grown since the fund launched, which is extremely rare for a high-yield covered call ETF. SPYI pays more, around 12%, and it's ideal for anyone who wants high income but doesn't want to get punished with taxes every year. So these are your foundation ETFs, strong, steady, and actually built to last. Now, let's move into the category that tries to squeeze more income out of the market, and that's where the trade-offs start showing. Next up, let's move into the tech-heavy category, the NASDAQ 100 covered call ETFs. They pay more than the S&P 500 ones, but they also come with more ups and downs because tech stocks move a lot more. And that higher volatility is actually why these ETFs can pay higher income. The options they sell become more valuable when the underlying stocks swing around more. My top pick here is QQI from NEOS. This fund has been a standout since it launched. Right now, it's paying around 14%, which already sounds impressive. But the bigger story is the performance. Since January 2024, it's been returning almost 21% annualized. For a covered call ETF, that's extremely strong. QQI manages to strike a balance that a lot of funds in this category don't. This category is best for investors who don't mind being heavily concentrated in tech. If you're younger, or if you already believe that tech will continue to dominate over the next decade, these NASDAQ covered call ETFs can be a great high-income layer. Just remember, tech moves fast, so your income will look great, but the ride won't be as smooth as S&P 500 funds. Now, let's move to a very different type of covered call ETF, one built for maximum stability and reliable month-to-month payouts. All right, now let's talk about the most conservative covered call ETF in the entire lineup, JEPI. This is the one almost everyone has heard of because it's basically the industry giant. JEPI has over $40 billion under management, which is massive for a covered call fund. And the reason it became so popular is pretty simple. It's built for stability first, income second. Right now, JEPI's 30-day SEC yield is about 7.2%, so it's not the highest payer on this list, but it's one of the most predictable. And here's something important most people don't realize. JEPI uses something called equity-linked notes. You don't need to understand every detail of those, but the main thing to know is that it makes the taxes much simpler. The trade-off is that most of the income ends up being taxed as ordinary income, which is the highest tax bracket, so it's not ideal for a normal taxable account. It works best inside Roths, IRAs, or any tax-advantaged account. The real strength of JEPI is the defensive way it selects stocks. In bad markets, it holds up way better than the S&P 500. In fact, during the 2022 bear market, JEPI actually beat the S&P by more than 14%. That's a huge difference, and it shows you how protective the fund is when things get ugly. But it does come with one major downside. The payouts jump around a lot. Historically, the distribution has ranged from about 25 cents to more than 60 cents per share, so you're still getting steady income, but the monthly amount isn't as consistent as some newer funds. So JEPI is the safe and steady option, perfect for retirees or anyone using a tax-advantaged account who cares more about smooth performance than chasing the highest yield. Now let's talk about international diversification, because a lot of investors don't realize this. Almost every covered call ETF is built on U.S. stocks. That's not bad, but it does mean your entire income stream depends on one market. If you want to balance that out, you gotta go international. My top pick for this is IDVO. It pays around a 6% yield, and it holds over 70 international stocks across Europe, Asia, and other developed markets. The main benefit here isn't sky-high income. It's reducing how much your portfolio depends on the U.S. market alone. Now let's talk about some ETFs that shouldn't be a major part of your portfolio, but they give extremely high yields, so it's good to have some amount of them. Now let's move to something completely different, Bitcoin covered call income. And yes, this actually exists. BTCI from Neos is one of the most unique ETFs out there. The yield is wild. Depending on Bitcoin volatility, it can sit anywhere between 22% and 36%. And surprisingly, even with those huge payouts, the catch, it hasn't even been around a full year yet, and it's tied to a single extremely volatile asset. That means we have no idea how this thing behaves in a real Bitcoin bear market. So this category is only for people who want a small speculative slice, like 5% of their portfolio at most. High upside, high risk, and absolutely not something to rely on for stable income. And finally, let's talk about the newest and riskiest category, AI and thematic covered call ETFs. AI KI is the big name here, and the headline number looks incredible, a yield around 38%. But here's the honest truth. The price performance has been negative. So yes, you're getting paid a ton, but the value of the fund has been going the opposite direction. With these high volatility thematic ETFs, the only way to make it work long term is to reinvest the distributions, because the yield alone won't save you. This category is basically the extreme end of covered call investing. Great for pure speculation, but if you're a conservative investor or if you need predictable income, this is something you skip. If you want to know about some more investments that's going to help you a lot in your retirement, make sure to watch this video. I'm sure it's going to help you a lot.